Chapter 12, Learning Objective 3, explain the major provisions of all life insurance policies. Life insurance policy is a written contract between the insurer and policyholder. Every policy is going to have four named parties: the insured, the owner, the beneficiary, the contingent beneficiary. The insured is the person that is insured. So in the event that person dies, then the policy will be paid out. The owner can be the insured. The owner can be someone else. An example of someone else might be a company or another spouse, or the other spouse, not another, because there would only be two, provided we're not polygamous. But anyway, so the beneficiary is the individual that will be paid, or individuals that will be paid in the event that the insured dies. Contingent beneficiaries are the individual or individuals that will be paid in the event that the beneficiary has died. The life insurance policies are all organized in the same fashion. They will have declarations. Declarations lay out the descriptive aspects of the policy, who, what, where, when of the coverage. Insuring agreements are basic statements that detail the obligations of the insurance company in return for the payment of premium. Exclusions narrow the insuring agreements. They exclude certain coverages. They could exclude death from some means. Say in the event that you have had a history of heart problems, they might exclude heart attack from your coverage. Conditions place obligations on the insured and the insurer that are requirements of the policy. They might lay out cancellation provisions, prohibited behaviors, and so forth. And then finally, endorsements or riders, which are simply amendments to the policy. Life insurance applications is the policyholder's offer to purchase a policy. The application becomes part of the policy. We'll talk about this a little bit more in a minute. The lives covered will be spelled out in the policy. There are a couple different types of these policies. First is called a first to die policy. When the coverage applies to more than one person, this type of policy would pay when the first person dies. For example, if both spouses were covered under the same policy, when the first spouse died, that policy would pay. There would be no additional payment if the second spouse died. The survivor joint life policies would pay, using the same example, when the second spouse died. There would be no payment when the first spouse died. The additional term that related to insurance policies is called an incontestability clause. What the incontestability clause usually says that the insurance company has a set period of time, usually 2 years, to contest anything that was misstated in the application. After that, it's any errors are moot. They're meaningless. Policies typically have a suicide clause. An example would be that coverage for suicide is excluded for 2 years from the inception of the policy. This is pretty obvious. It would prohibit it's to discourage somebody who's suicidal from purchasing insurance, because They don't want you to buy the policy and then commit suicide the next day and have to pay some large settlement. So a lot of policies, I'm fairly certain, exclude suicide altogether. Some policies, mostly cash value policies, pay insurance dividends. These are called participating policies. Policies that do not pay dividends are called non-participating policies. There's also a death benefit, and that is the value of the life insurance. It's simply the amount that will be paid to the beneficiary when the insured died. Grace period applies to a lapsed policy. In the event that premiums are not paid, most policies have a grace period that allows them to make up those payments and reinstate the policy. Multiple indemnity means that under certain conditions that the policy will pay additional for certain causes of death. This could be cancer or an accident or something of that nature. That can be double indemnity, triple indemnity, and so forth. And what that means is the policy would pay out double or triple in the event of death from one of these specified causes. Next thing is a policy illustration. The policy illustration will include the guaranteed minimum rate of return and the current rate. That we'll see an example of that here in a second. There's also what are called non-forfeiture or cash surrender values. These are net cash surrender value is the value of the life insurance policy at some point in time if the policy is terminated. So, Table 12.1 shows is a policy, sort of an example of a policy illustration that gives you an example of what some of the values you might see. You have guaranteed versus current rates. This policy has a 2% guaranteed rate, and the current rate is 3.1%. The value of both of them in year one is 0. This is due to commissions paid to the broker or salesperson. 2, the guaranteed is 0, and the current is $96. Again, the values of all these in the first few years are very, very low because of commissions. We can see that there's a very significant difference between the guaranteed rate and the current rate after 25 years, $3,400 based on that 1.1% difference in the rate of return. So next thing is policy loans. You can borrow from your life insurance policy or your cash value life insurance policy. The rates on these are typically very, very low. But the reason they are very, very low is because you're borrowing money from yourself and you're paying your insurance company to do so. It doesn't really make a whole lot of sense. The other types of policy loans include an automatic premium loan. Automatic premium loan takes money from the cash value and makes premium payments in the event that they lapse. Limited benefit clause is an extreme case. In the event that the insured becomes completely incapacitated or terminally ill, or death is imminent, the policy will go ahead and pay out the benefit. These types of things are pretty rare. There's also a waiver of premium that can kick in the event that the the insured becomes incapacitated. Guaranteed insurability, we've talked about this previously. Guaranteed insurability with a cash value life insurance, very similar to guaranteed renewability with term life insurance, allows you to purchase additional coverage even in the event that you develop some medical condition that would otherwise make you uninsurable. Settlement options, first is lump sum. Second is interest income. Interest income would simply pay you the income that accrued on the policy based on that rate of return, whatever it was during the given year. Income of a specific amount, you would draw that specific amount until the value in the account went to zero. You could have income for a specific period, so you could draw the settlement for 10, 20 years, for example. Income for life is effectively you would be buying annuity with the proceeds of the policy, and it would guarantee you income for life. The interest rates, typically are, as I've said repeatedly, are very low, and you would probably be better off to take the settlement and invest the money on your own. Name the 5 components of all life insurance policy: declarations, insuring agreements, exclusions, conditions, endorsements, or riders. Distinguish among the insured, the beneficiary, contingent beneficiary of a life insurance policy. So the owner, insured, beneficiary, and contingent beneficiary. The owner is the person that purchases the policy. The insured is the person that's covered. The beneficiary is the first person or persons who are going to receive the policy. The contingent beneficiary is the second person or persons who are going to receive the benefits in the event that the beneficiary or beneficiaries are deceased. Identify the 5 settlement options for the payment of proceeds of a life insurance policy to its beneficiary: lump sum, interest income, income of a specific amount, income for a specific period, income for life. Distinguish between automatic premium loan and a waiver of premium option in a life insurance policy. The automatic premium loans are out of the cash value and prevent lapse in policies when the policy are not paid. Waiver of premium allows a premium to go unpaid without penalty in the event that the policy becomes permanently and totally disabled. Next, explain how guaranteed renewability for term life insurance and guaranteed insurability for cash value insurance protect and insure people who develop serious health conditions. Both types of insurance enable you to purchase life insurance even though you would not have otherwise been able to purchase insurance, because they cover you even though you've developed, or the insured has developed, some medical condition that would otherwise make them uninsured.